We are on our final podcast of the year, Willie.
Okay. Not final ever, right? I still get to see your lovely face every day.
Sadly.
God.
But it's the final episode of the year of Finex. We just want to kick it off by thanking all of our listeners. We have had tremendous support from everyone, and we really appreciate it. And the great feedback everyone has given. I mean, we've gotten hundreds of feedback. We've gotten over 10,000 views per episode, I think, average, which is fantastic.
Nice.
And it's great to be able to have an open dialogue and get feedback from not only our peers, but also from the general public asking questions, because we're able not only to talk about these complex issues, but to break it down a little bit and how it matters to them.
Mm-hmm.
So I think we're doing a good justice here for this complicated world that we're in. I mean, it's getting more complicated by the day based on how the economy is going, all these new products and services that are coming out in the financial world, regulatory issues. So it's a complex matter. We very much appreciate the support. We will continue this through 25 and beyond. We hope to have more guests joining. So it's been you and I, but we have talked about it. I think it'd be great to have guests to join us from different aspects of finance and even regulatory, because in this day and age, even more so than ever, the world of business and government has been really integrated. It has been for a long time, but it's going to be more moving forward. So in this episode, we're going to recap 2024. It's been a very interesting year, and we're going to make some bold predictions for 2025, not financial advice, but our bold predictions of what we're seeing that's going to happen in 2025 and how it's going to affect you. One of our not colleagues, but one of our peers, Apollo, has come out with a bold prediction that pretty much reflects what we've been saying since 2023.
Mm-hmm.
And we predicted 25 was going to be the year, and it's looking like we are both sadly, but also, okay, we're right, true. It's one of those mixed feelings, right? Because there's some moments where we want to be wrong. We want to be right when it comes to investment decisions and general feedback and advice. But also, we want to be wrong sometimes because some of our predictions are a little bit grim. So it's a very, very fascinating position we're in. But yeah, Apollo did come out and validate what we've been saying pretty much over the past few years, and the timing we've been saying is pretty pinpoint. And then we have a couple questions from our listeners. Yeah,
they slid into our DMs.
Well, I apologize. I get so many damn DMs. I am terrible with responding, so I apologize. But I found out that the way Instagram and even X, they filter it. So you have people that follow you or your friends or whatnot, and then you have ones that are the general public and another one. So they filter it. So I thought, gotcha. That's cool.
Okay.
I can click through this stuff because, depending on who you are, I get positive or very negative feedback.
Well, here I was worried that all the DMs were getting buried under the Lord of the Rings memes that I send you.
No, that gets in one tab. Everything else gets another tab.
I have my own tab just for memes.
Yeah. Cool. You and the inner circle get the separate tab, and I didn't know they did that, which is very cool.
How dare they make things easy?
My X account, dear God, I don't know. It's a mess there. But anyways, let's get to the core issues here. So 2024 has been a hell of a year. The markets have been extremely bullish. The Fed kept the rates pretty stale for a while, and then bam, in September they hit it with 50 basis points, which we thought was too much of a shock. And if anything, they should not have cut because inflation was not controlled yet. And as you pointed out, the Fed decided to address the job market instead of inflation itself, which was a great mistake.
Yes.
And now we're seeing
going to get neither solved, honestly.
Right, and that was a hot mess, and that's part of the reason why and I'm sure people saw, we shorted the treasuries, right? We shorted the U.S. treasuries, and that's something that we don't like to do because we love America. We will never get away from the U.S. markets. We believe in the U.S. markets in the long term, but it was too obvious because clearly the data did not show that it was proper to cut 50 basis points. Even 25 was a bit much in our opinion.
Mm-hmm.
They should have, if anything, hiked it a little bit further to get under control. And now there's a lot of issues we're going to address. Let's see where we're going to start here, because, I mean, overall, here's what's happening, right? Here's what's happening before we break it down.
Yeah.
Markets have been going up like crazy
Yes.
for no fucking reason, right? I will throw in French today. And there is no reason for it to go up. I mean, valuations are ridiculous. And by the way, we're talking about the general market. People go, oh, well, this stock's doing well. I'm like, okay, listen. Certain companies will do well. Certain companies would not do well. You got to look at the overall market. The overall market is way too hot right now, and for no reason. So you have that going on. You have inflation actually ticking up again. And when you see revisions, and for our listeners, revisions meaning, yes, they release the data, but there's always revisions because there's not enough time to sort through the data. So they need extra time. That extra time, the revisions happen another 30 days later. So October comes out, and then November comes out. But November comes out not only with the November data, but also the revision of the prior month. And the revisions have been up. Okay,
yeah. Up on inflation, down on jobs.
Right. So all that's been up. So you have all that going on. You have inflation ticking up. You have the markets going up, and you have the Fed that's lost control because no one knows what's really going on. And we just don't understand where the hell policymakers or our peers at Wall Street are going with this. Everyone has their heads up their ass so far and so deep, they can't even hear the outside. And they can't even see anything because it's so dark, because they're so blinded by their heads so far up their ass. And it's actually infuriating talking to some of our peers and even folks in general about these issues. And they're trying to come up with these narratives. And I'm going, okay, look, I'm not being a media skeptic, but a lot of these people like Jim Cramer and all these analysts on the media front, except for a handful of them, are really going, we don't see anything that's a concern. And then you have some of these analysts, and many of we don't listen to analysts really. We have our own internal team and ourselves to rely on because we stick to fundamental principles and numbers that we look at, both from each company standpoint, but also macro and micro economics. We keep it simple, and that's why we're able to have a Sharpe and Stratina ratio that's outrageously good while having a 60 to 70% year-to-date return, which usually for a Sharpe or Stratina ratio, simply put, listeners, that's just a calculation, a number that shows how risky your investments portfolio is. And we are extremely, extremely low risk, but yet we have returns of extremely high risk, which is a very rare combination. That aside, we just don't understand where they're coming with this, right? Clearly, the numbers they're looking at is either skewed, or too short term, or make believe.
Or they're based on beliefs, like they believe that market believes that more rate cuts are coming. And the sad part is, so we're recording this on 15th December. The Feds still have time to screw it up before the year's over.
Right, because there's one more decision left.
There's one more decision, and they're probably going to cut. And I think this past week when I looked on the FedWatch tool, there was a 98% probability of a 25 basis point cut, which I'm sitting there like, what planet are these people on? Right?
Yeah, it's crazy.
I get that you want to address the labor market. Fine. What doesn't get talked about enough, one of the few times that I actually agreed with Senator Liz Warren back when all of this was new, and she grilled Powell over the risk to the job markets. And again, I don't agree with anybody ever at any time for any reason. But she did bring up good points, and now we're seeing that probably a little delayed from when we expected. But the measures of inflation are up: CPI, PPI, and core. They're all climbing. Imagine that you cut rates and inflation accelerates. Who would have guessed? Except literally every person that studies macro 101 understands that relationship. And the problem with it is not so much one of intent, it's one of timing, and it's one of degree. I understand Powell wants to address the jobs market. He should. That is literally one of the Fed's dual mandates. But the other thing is, you let inflation run for so long, and we're gonna have a soft landing, and we're gonna tick. It's only been ticking upward. Yeah, you get drops month over month, and everyone celebrates, and the S&P rallies. I don't care. Look at the long-term trend. We are still trending upward. And again, all three measures are up. PPI, I think, is up 3 times what it would have been since 2020 had we kept it percent. And the other consumer ones are up double what they should be. And now you're getting to the point where you're cutting rates to save jobs, but inflation pricing has gotten to the point where businesses are going to cut jobs just to survive. You've really painted yourself into a corner here. And I know Jamie Dimon, Saint Diamond, has mentioned more than once a few months ago the S word of stagflation that nobody wants to talk about. And that conveniently gets buried. This is what's going to happen if you continue, not you, you're not in charge, Powell, if the Fed continue to do what is being done. And the fact that you cut rates twice and the treasury yield, especially on the 10-year, increase. So I got it here. The last rate cut on October 18th, the 10-year treasury was just over 4% close. Now we're up back to almost 4.4%. You know, that's not how that's supposed to work. So I think what we're seeing here is, you mentioned, I'll put words in your mouth. I think the Fed are losing credibility in the eyes of the market in a lot of ways. I think they can try to salvage one or the other, but they probably ended up screwing up both. And I think the market see that. And if they want to rant and rave about, we're going to go bull into 25, more power to you. Reality will prove people wrong.
Right. I think the problem too is people are still in this mindset of post-COVID. Technically we are post-COVID, don't get me wrong, right? And we've had these conversations multiple times with our colleagues and peers on the street and others, and there's still this mindset of, oh, it's post-COVID, we're still rebuilding back from COVID. Okay, it's been
3 years.
It's been 3 years of coming back, okay? And it's now really post. It's like it's like a wound, right, on your body. There might be a little scar, right? But you can't say, oh, it's still an active wound. Your body's past it. Like, you're ready to go. You're ready to go play sports again or move on with your damn life. It's okay, right? You can pour salt on it and it's not going to hurt. So it's fine. So I think that's where a lot of these folks are still in their mindset of. And if anything, they should look at the post-COVID spending with consumers, right? Their savings have dried up. The stimulus money that they've were received has dried up, and now they're really tapping into credit in multiple ways, and that's scary. Before we get to that, though, focusing on inflation is really starting to get out of hand again. I mean, food inflation went up 31%. That was a big spike. That was a huge part of it, and that's what's really scary. I mean, look, I was walking through Whole Foods yesterday to go get groceries, right? Yes, people, I do shop for my own groceries because I'm very, very picky with my produce and especially my meat and seafood, right? I'm very picky on that. And even just look at simple things like avocados or bananas or milk or basic necessities, right? I mean, yes, granted, I ate organic avocados, but it used to be about like $1, $2 each. It went to $3.50 each.
Cool.
And even just regular avocados were going for $1.79 each. When I remember it was $1.30.
Used to be a buck.
Right, and that was earlier this year. That wasn't just a long time ago. I mean, I get avocados, the climate, all that plays a role, but still, to have that dramatic shift like that, egg prices, beef prices, chicken, the necessities that people need to live, costs are going up. Canned goods, all that is not what it used to be, and part of that's inflation, right? So that's a big jump. But then you look at the New York Fed's measure of inflation. Right.
I was just going to bring that up, the multivariate core.
Yeah, do you mind explaining what that is?
Sure.
People that don't know?
Well, the multivariate core is just one of the ways that the Fed used to calculate inflation. So depending on what metric you're using, whether it's headline.
Yeah, because there's core, headline, all that.
So core will strip out was it food and energy because of the volatility?
Which is stupid beyond belief, by the way, because those are things
stupid beyond belief. Last I checked, you need both to live. But multivariate core is just another way of trying to get at the truth of the matter in terms of different components of the CPI are weighted differently. Like that's what people need to understand. There are a lot of ways to get to the true number. Multivariate core is just another way of doing that. That's the long and short of it. And even that is up almost. It was up 2.8% in October. It's been climbing since June. There's a lot of indication. There's a lot of signs that indicate, the Fed never hiked rates to what the true neutral rate is. Right? The true neutral rate is the interest rate at which you actually stymie inflation. You see a cap and it starts going back down. The problem is that's only observable post hoc. So you basically have to keep hiking until you get an effect.
Yeah.
What the Fed did is, nibble, 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 nibble. Let's just take a year off. Screw it.
Right. I mean, they did things that we didn't disagree. I mean, we disagree with how they did it, right? They should have spiked it, ended early. Yeah. But if they wanted to drag it out, okay, then be consistent with it. Then take longer to get down to 2%. But the problem is they got impatient. So instead of hiking it quicker to address it quicker, they wanted to drag it. Okay, all right, fine, we're dragging it. But now they didn't drag it long enough. And they got all down to the 2%, and they did not time it right.
Jobs, let's cut.
Right, and that was the problem, right? They didn't do a sprint, so they're doing a marathon, but they found out that they're not in shape enough to do a marathon, and they quit. So that's exactly what happened. And now what you're seeing is, and again, this is why we short, the U.S. Treasuries. As soon as they cut 50 basis points September, we shorted it because at the time, where was it? It was like a 3.8 or something like that.
Something like that, yeah.
When we shorted it, and it got up to as high as 4.7, almost 4.8.
Mm-hmm.
Now it got down to 4.2-ish just about a couple weeks ago, but now it's back up to almost 4.4 again, because of this data. In any regard, what we're seeing now is inflation is picking back up again. PPI, CPI, core, headline, whichever you want to look at, it's ticking back up. Our bold prediction here is that inflation is going to shoot back up in 2025. This is one of our bold predictions.
Yeah.
In 2025, and Apollo just came out this morning saying it. And Apollo's a key. Apollo's very reserved in their predictions, right?
Yes.
And we've been calling it for a while now. That we knew, based on where things are going, because Powell has lost control, the Fed's lost control, because government spending like drunken sailors, consumers are forced to use credit and continue to grow debt. The Fed losing control and not targeting and not completing the 2% target and shifting to the job labor market. Now you see it tick back up. We are very convinced that in 2025, inflation will pick back up. And instead of going down to 2%, it's going to go back up to 3% or higher, right? I can see it going back up to 4 or 5% inflation, if not higher. If not higher. I'm not going to predict a number. I just know that's going to go back up, and that's going to cause a problem. And another bold prediction, this is me. I don't know if you want to confirm, Willie, on your end, but I'm also going to call for stagflation. And this is something that
I've been saying that for years.
Yeah,
of course I support that.
We've been calling it in late 23, early 24. We wrote a piece that called for stagflation in 2025 at some time.
Mm-hmm.
And sadly, we're seeing it, right? Inflation was going back down a little bit. Again, even though we disagree with how long they're doing it, at least they were doing it, right? So it's going down. They stopped too early. Now we've seen it tick back up the last couple months. So when you have that, and now we're going to talk the job market here. Now that's going up. Job markets are weakening, right? And that's a problem. And even if they cut, that's not going to address it because participation rates are super low. Wages are going up, but there's less people in the workforce that are active, less people that are participating. And what happens? That causes stagflation because then it's a rat race. Because no matter how much, not no matter how much, there's a certain number, but as private and public sector tries to increase wages, but they can't really hire more. And with AI being a factor now as well, because they're taking a lot of the AI can do a lot of the lower tier jobs. It's a rat race. And that's where you have stagflation. And this can be a 1970s style economy that we're entering in.
Yeah.
And this is what the new administration is going to have to deal with. Now, unlike back when Jimmy Carter and Reagan style, right? we were already in stagflation as Reagan was coming in as president.
Mhm.
Trump's in a new position in where we're going to enter stagflation due to the poor fiscal policies as he's coming in. Stagflation is going to hit as he comes in. So it's going to be a very interesting couple years to see how this administration handles this and how Powell handles it in this administration. Because again, we don't believe politics has a role in finance. And finance, I mean, obviously politics has played a big role the past decade now, sadly, in influencing that. So, but more than ever, the microscope of how politics and finance, especially with the administration, with the Treasury, with the Fed, how this is all going to incorporate. So yeah, so we are predicting inflation going up, and we're predicting stagflation, and part two stagflation, not only inflation going up, but wages and job market. Job market is a shit show, and we've already said it's been a shit show, right, for a while. I mean, because people look at U3, we look at U6.
Yes.
U6 is actually what matters.
U6 is the real unemployment rate, because that's the problem with when you look at U3, you're treating a job as a job as a job. That's not true.
Is that core CPI? Core CPI doesn't look at the whole inflation.
Right.
We look at the whole inflation number, food, housing, all that. Just like with U3. Go ahead. U3 only covers all jobs, not a breakdown.
Unemployment is a massive issue, and I don't just mean the prototypical barista with a PhD. Sadly, I've met more than one. But it's the part-time workers and it's the part-time multi-job holders. Not all jobs are created equal.
Right, that's in U6.
That's in U6. But U6 also includes basically the disenfranchised. I can't get a job, screw it. I'm done.
I'm living off of government and
living that's the thing.
Or living with my parents, which is a big issue, by the way, with young people now.
Yeah. It's all driven by affordability.
Yep.
And we actually had a post on our TwitX about specifically that. The number of people, I think it was like 27% of those who are no longer in the workforce have come to just say, I can just depend on the government.
Or my parents.
This is not judging, okay?
No, it's not.
We are not here to judge. We're here to state fact. And the fact is, that's terrifying. And if you look at one of the most depressing stats, so Federal Reserve Economic Database, free and public, I cannot stress that enough. People are like, where do you get these numbers? The number of unemployed for 27 weeks or more, 7 months without a job, which I honestly will lose sleep over if I think about that too much, has been on the upswing. The last time it was on the upswing, pre-COVID, which, let's face it, everyone got caught off guard, fine. The last time this stat was on the upswing, if you had to fancy a guess, it was when the last time housing was a hot issue was right before the 08 recession. So we have all of these signs that are pointing toward catastrophe. We have job numbers that continue being revised downwards, and the revisions don't bother me. You said before, you're constrained by time. You have the data, you got a deadline, you got to put it out, period. I understand that. It's the fact that they're getting revised lower every single time is what's concerning. I mean, I think it was the 4th of this month, the ADP numbers came out, and that was the first shot across the bow that's undeniable that the Fed's claim of a strong labor market was wrong. It's like, at what point are the policymakers and the politicians to say, like, okay, we need to do something about this, not midterms, not when the voters have forgotten about it. Like, this is a catastrophic emergency. And like we've posted more than once, this is also the second time since, I think, 41 that we are spending more on interest payments for public debt than we are spending on national defense. That needs to make everybody pucker up. That is wrong. There is something fundamentally wrong with that. It's not just an issue of financial responsibility. The knock-on effects of this are far-reaching, and nobody seems inclined to do anything about it because, hey, the markets are up, so everything's okay.
Yeah, and to recap, so not only do you have food and living, all expenses mostly going up, okay? But you also have people that are working multiple jobs, there are a lot of people working 2 full-time jobs, or multiple part-time jobs, or people are just not participating at all, or people are actively looking but they can't get a job. So you combine those two factors, it is a big problem. Now, people have told us, okay, well, retail spending is ticking up, the consumer is resilient.
Yeah.
Bullshit. Let's break down the numbers, right?
Tell
Let's break
them
down.
off, Vin. Go
Right.
off.
I mean, there's a couple factors in here. Credit, debt, all-time highs, right?
Yes.
So a lot of these consumers that are resilient, they're tapping into massive amounts of credit, right? Credit card debt's all-time high, household debt's all-time high. So they're compensating for spending with credit, right? So that's becoming a problem. And then this high interest rate, that's not good, okay? You're looking at delinquency rates are starting to tick up, right? Both auto, credit card, and you're starting to see mortgages starting to tick up, okay? That's starting to play a factor. And then you look at the demographics, right? This country's built on the middle class, okay? If you look at the actual spending of the retail consumer that's upticking, they are either the ones that, if you break it down, right, they tend to be the higher middle class or we're better off. They're the ones that are spending. This is why Louis Vuitton, Moet Hennessy, LVMH company, our friends at Arnault are doing so well because the luxury market is thriving because of that, right? So that's where the skewed data comes in. Okay, the luxury markets are doing really well, all this stuff, okay, fine. But everyone else is left out, right? And I'm not one of those people that I'm a capitalist at heart, all that kind of stuff and everything like that. But you still have to address that problem, right? Because that means that the top-down effect, bottom-up effect is not happening, right? And that's how it's supposed to work, right? As companies do well, they hire, they pay more, all the sorts of things, right? That's not happening, and that's a big problem. So again, when people say consumer resiliency, it's a huge discrepancy. Not to mention, if you look at the wealth, right? There's a huge wealth transfer happening. So baby boomers a lot of money, right? You see a lot of their family members using their parents' money to spend. All right, you see that happening. Okay, that's a big amount. Or they're now starting to inherit it or take some of it and spending. So again, and that's a small portion of the population.
Yes.
So there's big discrepancies, and that's where, and again, this is why people ask why our family office and then funds are doing well, is because those are things that we look at and we pick companies that are going to survive or thrive in this type of environment or what's going to come about.
Yes.
Right? Because that's the data we look at. All of this mainstream data that you're seeing, it's all bogus. And that is a huge problem. And the fact that Apollo came out and we're starting to see others coming out, validating what we're saying tells you a lot. So that's the biggest concern. And that's our big prediction in 2025. Labor market, we believe, is going to weaken. Inflation will go up. And we're going to start entering stagflation because all this post-COVID thing, tune out that noise.
Yeah, no, that's done. That was 2022.
That was done. If anything, you can stretch it to 23. But 24 was already the transition period. Okay, we're post-COVID. You go to New York, you go to all these major cities, it looks like pre-COVID again. You go to the restaurants, you go to the retail store, it's all packed. So you're not...
Unless your favorite place got shut down.
Yeah, I know.
I miss I want a bagel from there so bad.
I know. So that's what we're seeing. And to our folks listening, we'll get through this. I mean, if and when stagflation hits, which we are making that bold prediction will happen in 2025, it'll take a couple years, but just be patient with it. Our economy goes through cycles. That's about economics. It goes through cycles, right? And that's the biggest thing about, if you study it, with the economies, especially like ours, what goes down comes up. What goes up must come down. It just happened. You study history, right? People thought, oh, hey, it was the end of the world. We came back better than ever, right? 2016, we came back. 22, we came back. Great Depression, we came back. 70s. So that's all, like we'll be okay. I saw the housing average home buyer age now, new first time, it went up to 38. That's also a problem.
Yes.
Again,
that's why people are living with their parents.
Right. And again, we're not shaming that. We don't blame you. Like, if anything, we encourage it until you get your finances in order.
Absolutely.
Right? Because the last thing you want to do is, try to, boost your ego and try to be self-independent, which you are in many ways. It's just, you're better off saving and doing your best to build a cash pile before you do so. And we had a question about this in our DMs, and also in general, by the way. A lot of messages come in. Even one of our partners asked, should they buy a house, right? Should they buy a house? Like, they have the money to do so, but they're worried about the housing market because people are dumb in general, right? In general.
Dude, were you waiting for me to drink before you said that?
Yeah. In general, okay? I'm not going to alienate people, but I am. It's just like how people acted to that Luigi guy that shot the
My God.
United Healthcare CEO. They were having thirst traps and they thought he was a folk hero. Like, people
What
are
the
stupid.
hell?
People
Yeah.
are stupid. But again, in general, let's just say we have faith, okay? But people are already feeling that vibe that the economy is not good, and that's how they voted. I mean, in November, you saw it. That's how
Yep.
people voted. They were
Yep.
just tired of the economy. They're tired of being the rat race, and they missed the days of when things
They
were
could
costing
afford
low.
things.
They could afford things, all those things. Like even post 08, right? You were
Right.
able to buy things and everything, despite how everything gone. Now that's a whole other conversation with quantitative easing, but the the biggest thing about the housing is it depends. That's our answer. It depends, right? If you're in a hot market, so that there's certain markets that will not fluctuate because it's just a hot area. Boston, right? Boston area, high academics,
Yeah.
right? Great job market because some of the major companies, both medical, service, all there. A big place for expats. A lot of expats move there. So that's a market that, if you can, just buy. And even if the mortgage rates are high, just refinance in a couple of years. But again, make sure you have that cash ability to do so.
Yes.
Greater Philadelphia area, absolutely. Just the same thing. Big services, pharmaceuticals, a lot of financial services here as well. They're going to thrive. So even we saw the math in 08 when the housing market crashed. The Greater Philadelphia area barely budged.
Yeah.
So
And
it was
again,
fine.
public data. I think it's on the Zillow home price or home value index. You can see that by region.
Yeah,
These
it
places
barely shifted.
Yeah, like
Yeah.
it'll wiggle and it might even dip, but it's not this 20%, crater.
Yeah, Washington, D.C.
Yep.
area, right? I mean, look, the federal government's there. You have a lot of young people there, great schools. You have a lot of service businesses there because a lot of talent's there. I mean, just right outside of the district, you have the Virginia, Maryland area. A lot of companies that are there. So
My
again,
fellow Beltway bandits in aerospace.
there you go. So that's just it, right? So it just depends on the market you're at. Then that's where you have to do a little research on where you're at to be able to determine that decision. So overall wise, as a nation, not a good time. We see housing prices plunging because again, all these builders are trying to catch up, but as they're catching up in supply, you're seeing inflation going up again. You're seeing job markets weakening, and so as they're trying to catch up to demand, that demand may go down, and then you see that X chart, right? And that gap is what's going to cause a huge issue. And that's where housing prices be an issue. And then with inflation going up, what happens? Interest rates go up, right? Because they're going to have to do that.
They have to.
So that's going to cause a clusterfuck. But in certain pockets of markets, that is not going to matter, right? It may matter a little bit, but again, you got to look at investing in a house like any other asset, whether it's equities or bonds or whatnot. It's a long-term look, right? It's a 30-year mortgage. It's probably a forever home. It's going to go up and down in value over those 30 years, no matter what, okay? So if anything, that's how you got to look at that as an investment. You buy the home. It's a 30-year investment. Don't look at every like, oh, my God, it went down 3% in value. 5 years from now, it'll probably go up 7%, right? Or whatnot. So that's how I can look at it. It's like investing in the stock market when we tell people, unless that's your living like us, and that's what we do 24/7. You put your money S&P 500 index, like the Vanguard VOO or Charles Schwab's one or whomever, right? The S&P 500 index. Look over the long term, it's a 45-degree angle. You zoom in, it's a rocky ship, but overall it goes up. So that's how you look at investment in housing. And again, it depends on the market you're in. And that's what you got to look at. So, markets in Florida, I'm always worried about, the new markets in like Southwest of America, even in Texas, certain areas, but even Texas is a little bit stronger depending on where you're at.
Yeah.
So again, that's what you got to look at, right? And You got to look at the historical value, not just the ones that are just, oh, they're hip and new. Everyone's moving there now because young
Right.
people are moving there. Why is that and what's establishing it? If it's because it's cheap, better living, that may not be the right answer because that's that moment. Do they have an existing job market that's been established for decades? Do they have a strong market for education and all those and an infrastructure, right? Because that's what plays a factor. I
Yes.
mean, Greater Philadelphia, you got so many great schools. You got a ton. I mean, Vanguard's headquarters in that area. You have Tiger Global Management there. You have big service industries. I mean, Greater Philadelphia is known for services and pharmaceuticals,
Yes.
right? And schools. So that's going to be well established. That's going anywhere. Boston, we just explained. DC, we just explained. So they're established. So no matter what, there's going to fluctuate. But even New York City, outside the commercial real estate, just take commercial real estate out of the way because there's a lot of shifting moments. So it's hard to analyze now. When people make bold predictions that are hard and set, they're stupid because they're dumb as hell because it's a shifting tide right now because people are still adjusting to the work from home. Companies are deciding what's productive or not. So commercial real estate is dumb for people to make an analysis right now on that. You can make a short midterm analysis, but for long term, you're an idiot for trying to do that. But you take commercial aside, you look at a residential, it's still strong, right? Because people like living there. There's really good schools. It's opportunities there. But look, financial services, most companies are still there. That's the thing, right?
The financial capital of the world.
Yeah,
whether you
and
like
it's still
it or
there.
not.
Right, and it's not shifting either. And other jobs, legal, services, I mean, fashion, food, all that stuff, it's still there. So residential-wise, if anything, it's getting stronger. So, and that's, I mean, it's still home to the most billionaires and millionaires. And the past 3 years, each year it's ticked up. And people still see, and I believe in it too as well, personally, New York is the place where you have big dreams, you want to make it. That's where you start, right? You start from that little ass room you share with 10 other people, and then you make it into your own apartment. Right?
How big is this room if you have 10 other people in it?
I don't know. So that's how you got to look at the housing. So hopefully that answers it. You have anything to add to that, Willie? I mean, hopefully that explains it good for our listeners because that is one of the very prominent questions that we had is about that. I mean,
well, of course,
people are starting to get the inflation thing, and I think they just learned now that we do see it ticking up. Labor market's weak, and stagflation is coming. I think a lot of people are got that. That's why their behaviors are shifting, both politically, spending, and all that kind of stuff. But again, we're keeping politics out of it. I hate both sides; they all suck. But
we need somebody to run the place.
Yeah, we need someone. So, but from a housing market side, what anything to add on that?
No, so the data show what many people I think are intrinsically suffering through. It has literally never been a more expensive time to buy a house. And this is from, again, Federal Reserve's own data. If you look at the median, not average, because remember you have the skew, right? Median home sale price versus median income. If you're trying to buy a house by yourself, your median price is 10x what your median income is. As a household, it's 5. It has never been that high. And the average, that's almost twice what the average would be for those two stats since the late 1970s. I'm looking at my chart here. So it's absolutely terrible. And the thing that people don't understand and that always ends up catching them out, it's not just the sale price of the house. It's not just your mortgage payment. It's not just your taxes. It's not just your HOA if you have one. It's those little hidden expenses that don't get caught in the inspection that you don't expect. Like, well, your water heater fails in a way that the inspection wouldn't never reveal because it was internal to a valve. So unless the inspector has X-ray vision, which I don't think they do, yeah, it's these little unexpected expenses that concern me and should concern everyone because you feel it the most when it's housing because it's the most immediate. Like, if your water heater breaks, a cold shower will encourage you to fix it.
There's a lot hidden expenses in owning a home.
But it's the fact that Americans, by and large, are being stretched so thin and the savings rate is so low that we're almost to the point where any unexpected expense can do you in. Like we've all heard the people who go bankrupt because of unexpected medical expenses. But that shouldn't be the case with medical and housing and food and auto repair and like it's to the point where we've gotten so used to living on credit and just living out to the margin. Like if if your $1,000 a month is your take home, spending 995 of it, like that's becoming normalized culturally, and it's not just terrible from for lack of a better term, an operational standpoint. It's putting people at a huge amount of risk. But what are you going to do? Well, what part of the elephant are you going to eat first? It doesn't matter. Just start chewing part of it. And this is part of the reason why we harp on getting inflation under control so hard, because most of these other problems can be solved if you have steady prices that are actually increasing to your target, and you're giving time for wages to catch up. You're giving time for people to recuperate their savings. You're giving people room to breathe, which we haven't had room to breathe since we had the coronavirus that literally took away our ability to breathe.
Yeah.
So where does that if nobody's fixing it?
I mean, you explained that perfectly. Everything's going up, and that's why people feel they're drowning. It's not just two or three things going up; it's everything, like you just said, right? And I think that was explained perfectly. It's everything going up. Before, yeah, you may see some things going up, like housing or whatnot, but you can still buy groceries. You can still repair a water heater and still be okay, right? You're able to still go out and still enjoy a meal once in a while, right? But now everything's expensive as hell. I mean, we did the math, for example. I mean, the fact that, let's say Kava, we love Kava. Shout out to Kava.
Hell
Great
yeah, we love
company.
kava.
Not only food wise, but it's a great stock to
I'm
look
gonna
at.
go get some kava after we're done recording this.
Thanks for the invite.
I just invited you.
And so you look at all that, and people are drowning, and I think that's where. Oh, sorry. Back to the point. It's Kava, right? You look at Kava to make the same bowl in general. It's the same price as making it at home compared to going to there, which tells you a lot, right? It tells you a lot at where things are, because normally eating out, I mean, is a lot more expensive. Even fast casual is more expensive than eating at home, but that's not the case anymore. Even the McDonald's menu, right, is not as cheap as it once was. So that's something to look at. But for a lot of people listening, it's our general non-financial advice is have patience. Obviously people have spoken in the election, and we hope this new administration can get the economy under control. I know there's a lot of debate about that. We're not getting into that debate. We just hope that, they're able to do that. And at the very least, they chose a Secretary of Treasury that we know and have faith in. He's someone that understands microeconomics, and he's someone that has a pretty good plan. And we hope that, obviously the president, the administration allows him to do his job.
Yeah.
And we'll see what happens. But regardless, we hope that people are patient, but do what's necessary during this time to stay afloat, and then come out better when things get better, right? Because it's going to get better. But we said that a little bit earlier. The economy goes through cycles. And I don't believe we'll head to the Argentina prior to their doing well now. I hope it's not that way, but have patience, do what's necessary, put your ego aside, and save, invest where necessary, and know that hopefully in a couple of years you'll come out better. And it's ironic because we've had a couple friends of ours, right, who have thanked us, but we also have a couple of friends who went down the rabbit hole, right, didn't listen. And
what do you two idiots know?
Yeah, was not even that. It's
arithmetic.
it's not even that. They just didn't have the discipline, and
Sure.
the ones that listened to us are actually in a good position despite where the economy is now, because they listened to us during that time period, and they looked at the bigger picture. Meanwhile, a couple of others, they didn't listen, and they're in a really bad predicament right now. And some of these folks are real young. And we're like, well, if you would have listened, you'd be in a better position right now. So those are good examples of why, regardless of the economy, if you remain disciplined, you will come out better on top and better than most of your peers. And don't compare yourself to your friends or your peers or people on fucking Instagram, because all that stage, I can tell you right now,
Instagram is life.
Yeah, I can tell you a lot of that stage. So that's the biggest thing that we can give to people is follow that. And also don't fall for those fucking schemes on Instagram either. A lot of those guys are full of shit. and they're probably going to collapse here next year.
But Van, I want to make millions from home using other people's money. Are you saying Instagram is lying to me?
God.
The guy posing for shirtless in front of a yacht, he has to be legitimate. I think you hit upon something earlier that I mentioned healing a wound. I think that's a really appropriate metaphor. I think we're in a period where we need to start some economic debridement of a wound. For those that don't know, that means you're slicing away dead skin and other nasty things that prevent a wound from healing.
Yeah.
And it sucks. I don't envy anyone that has to go through that. But the simple fact is, if you don't do it, the wound's going to get infected and take your foot. So, we need to actually start addressing some of these issues. And yeah, okay, granted, the ideal time would have been in 21. Fine. I lack a time machine. We can't do that. The second best time to do it is today.
Yeah.
And yeah, it's gonna suck, and it's gonna be painful, and a hell of a lot more people are gonna lose their jobs. But if you don't do it, do we really want 1970 style inflation? I sure as hell don't. There's a reason I'm thankful I was born too late to live through it. But the other problem with that is, the worse the situation gets, the more extreme the measures you need to take to resolve it. Reagan is not here. Volcker is not here. The leadership getting the Fed chairs back and saying, do what you have to do. I'll provide high cover. Just get it done. Are we in an era where that's still possible? Those are some of the things that concern me.
Yeah. So look at the bigger picture, folks. Your patience will pay off. And it doesn't mean you can't enjoy your life, too. You can still enjoy it. I mean, you can still go out to eat once in a while, enjoy a movie and all that. I'm not saying just completely live under a fucking rock. It's just, have that discipline to be able to stick to it and still enjoy certain things. But, anything major and all that, just have patience. Because if anything, housing is going to get cheaper for you to buy. Again, depending on the market.
Depending on where you are, that could very well be the case.
No, like for Greater Philly, Boston, D.C. area, you're not going to see that much of an adjustment.
For South Florida.
Yeah. Now, talk about markets, like housing markets. I mean, stock market, I'm sure that's a big question. People have been asking us about the stock market, right? And we've had long conversations with our peers about equities and everything. And I know our listeners have been asking about the stock market, and they're worried, like, do they pull out? Things are doing really well. My thing is never pull out. Sorry, I had to throw that in there.
I kept a straight face when you said that.
Yeah. Well, if it's I mean, here's the thing, right? The stock market's bull run is ridiculous.
Yes.
I mean, it's a great time, and for people who have equities and all that, that's fantastic. It's doing well, but it is really overvalued.
Uh-huh.
And we're going to enter a bear market at some point. And I think that's 2025. I think 25 will be a bear market. If it continues to go up like crazy, okay, we're wrong, but that's going to prolong a crash even further, and it's going to make it worse.
Yes.
So our prediction on that part in equities is unknown. So we're not going to make a bold prediction on that. But if stagflation hits, what happens, Willie? Which is our bold prediction.
Well, that's a good question, Vin, because the problem with stagflation is that when you have high inflation and high joblessness, can't say unemployment because remember the figure that they're tracking doesn't count people who've given up.
Yep.
Anything that you do to fix one makes the other one worse. And we're seeing that now,
But how do you see that affecting equities?
You sooner or later they're going to crash. Okay, period. Like you need consumers to buy your stuff. You need employees to make it. So if joblessness continues to increase, it's going to start hitting even the industries and the businesses that require that have very high barriers to entry. So the professional services, the high-tech medical, the high-tech period, it's gonna be a contagion. The market is already overvalued. Some people say 25%, some people say 10. I think making predictions on that is kind of a shotgun approach. I don't want to do that personally. But I mean, if stagflation hits, we're going to need a strong external shock to restart the system, because that's the only thing that can happen. That's the only hope we have. Yeah, in the
Right.
70s, we kind of got a little lucky because of oil. You can't just hope on luck to fix your problems. So we're in a very precarious position. Obviously, what you just said is spot on. Don't ever pull out if you're investing, especially if you're a retail investor. You know what? Yeah, okay, I dropped 10%. Well, life sucks. It just means it's cheaper, buy more. Unless you are living on dividends, unless you're living on, the high frequency itty bitty movements, for most people, like you said, it shouldn't matter. Just get the index fund and hold on.
Yeah, if you're a retail investor, it doesn't really matter. Like your 401ks and all that, it doesn't really matter because, again, we talked about it before. The U.S. stock market goes up. Now, my input is this, right? I mean, this is a two-part answer because we have peers that are asking from Wall Street and our peer colleagues asking about what our thoughts are on that. We gave answers, but we might as well put it public. Then we have retail investors and friends asking about that. Retail market side, you're not experts, okay? Regardless if you're trading on Robinhood and you think you're an expert.
Bro, Wall Street bets. Come on.
Yeah, I mean, you're not an expert. So if you look at retail side, you all have full-time jobs. You don't have time to be an expert to look at this. You don't have quants. You don't, this is not your full-time thing. If you have a 401k or you put some investments into the VOO or whatnot, or a mix of it, you just continue to contribute and have faith in it. And it's, again, what we talked about. It's a 45-degree angle when you zoom out, and things will rebound, right? Now, the thing I've been saying, though, is that the difference may be is that the last 30 years of returns from the stock market may not be it may be greater than the next 30 years, right? So you look at this moment in 2024, right? The last 30 years have been tremendous, right? The S&P 500, we look at the VOO index, the S&P 500 index, great returns, right? Despite all the ups and downs we had, it goes great. Now the next 30 years, I don't think we'll have as great of returns over the next 30 years as we have over the past 30 years, but we'll still have great returns. It'll still be a 45-degree angle. So for people listening, it'll still go up. But we strongly believe in the U.S. economy. It's the best economy. There's a reason why the rest of the world is garbage when it comes to investment in the stock market, and why all the foreign money comes to the U.S. I mean, that's true. I mean, the uptick in foreign money is flooding into the U.S.
Inflows in foreign cash.
So I mean, because we are the hope. Just despite how up and down we'll go, people have more faith in the U.S. So do we. But I just don't think the next 30 years will be as good as the past 30 years. But it'll still go up. And if anything, the way you look at investing, again, so now we're shifting over to our peers, right? Professional investors. That still applies. But the way you look at it is that so many people look at just the overall market in general. We don't believe in that. We believe in microeconomics and how the economy is going to do. Yes, overall economy, stock market, whatever. You have to look at individual quality companies, right? What they're going to do and which companies you're going to select based on the macro and microeconomics. That's how you should look at things. And it irritates me when you hear peers and all talking about, oh, the overall market's good, buy this and this and that. I'm like, why are you buying that? And you can't just use the AI buzz and all that kind of stuff, because that's going to be a bubble in itself, right? You have to look at, okay, what quality companies are doing really well. Fundamentally, they're great. And then from there, you break down, okay, if we know stagflation's coming in the next couple of years, how are we going to select a company that's going to do well during that period, right? Or which company is going to survive the next 10 years easily, right? That's how you got to look at things. And for those retail people that want to dabble, that's good. That's good non-financial advice as well, right? It's being very selective and understanding companies, both established and the ones on up and coming, that are going to do well based on what's coming due for the economics, right? And also what's going to happen in the world. Look, so some of our investments, people are like, oh my God. And it's like, yeah, because we saw it coming, right? You look at companies we invest in like Rocket Lab, space industry is going to thrive, especially with this new administration. I mean, the past administration has done well too with it, but space race is continuing to go well. But we look at a company called Rocket Lab because they're not only doing space, but their technology is going to apply to other areas, right? Defense, as well as commercial satellites and all sorts. So they're more well-rounded. So that's why we looked at them. I think we bought it at $3. It's at 24 now. It hit 27 at one point, but again, it fluctuates, right? You look at a company like Palantir. We never do IPOs. IPOs never do well. It tanks. It goes up and down. It's volatile. But once that got out of the way, and then we did our homework, seeing okay, their books are okay, pretty good. But we know that look, the PayPal mafia owns it. Now they have a very friendly administration to the PayPal mafia. But aside from that, that's a big factor. We see a huge shift in defense, right? As well as just the companies in general. People look to be more efficient. That's what they use AI for. They want to be more effective. That's what they use AI for. And that's where a lot of the money's going. We saw a lot of contracts they're getting, a lot of new commercial deals they're getting. So we bought in at what, 22, and now they're at 70
I think 23 plus. Or so is when we
right,
got in.
Yeah, but now they're at 70 plus, right?
Yeah.
So in a very quick amount of time.
Yeah.
So again, we applied microeconomics. We looked at what the company fundamentally is doing, and we look at their products and services and where they're going to head. It's going to be volatile because it's a new AI company, or newer, relatively AI company. Even though it's like, yeah, open since to that. Well, look, it's still pretty new. We're still going to keep an eye, but in the long term, we see them being possibly like an Oracle or something down the road.
Oh, absolutely.
Because of what they're doing. So again, it's a long-term hold, but we already saw the gains already. We see a big shift in the demand of energy, both because of technology and all the data center. Because all the stuff you're using, your phone, all the apps, the AI that's being used, that requires a lot of energy. And data centers eat a lot of energy up. So we look at existing power grids that are going to need a boost. We look at natural gas. We look at nuclear energies, and that's how we invest. So again, we're saying all this because regardless of what happens, we look at it from a standpoint of trends, not hipster trends or like, oh, this is the hottest thing. No, we look at it from a standpoint of trend of like, okay, well, in the next 3, 4, 5 years, a decade, this is where the world's shifting. And then we look at the microeconomics, how that's going to affect. We look at, okay, what's going on politically, and then we look at what consumers are doing, right? And then we make our decisions from there. So if you're an institutional professional investor or retail investor, again, retail, hopefully you just, look at the VOO, right? But if you want to dabble with some extra money you have, that's how you look at things, right? That's how you, and it's a lot different than a lot of what people teach. Correct me if I'm wrong, Willie. I mean, you and I went to very good schools for business and finance, or even friends that work at at banking or investment firms. They don't look at it that way. A lot of them are quants. A lot of them are looking at different types of things. But that's why we have that very low risk numbers with high risk returns. So that's how we do that. But in any regard, hopefully that helps our listeners kind of understand where we're looking at it. And and our bold prediction, another bold prediction in 25 is yes, we see stagflation, right? We see the stock market starting to flatten out a little bit. We're much more bearish, but particular industries will thrive, right? Particular companies in AI, not all AI, right? Because I think there's going to be a slight bubble in AI because there's a lot of noise there. But certain companies that are actually delivering real products that deliver real impact will do well. Energy is going to do real well, not because the new administration drill baby drill. No, it's more because of the energy demand needed, and then consumer staples, right? Because with inflation going up, weakened job labor market, people are going to go more towards value, right? So they're going to go to more Costco's, they're going to go to Walmart more. They're going to go towards that. They'll
yeah.
What else? What other thoughts, Willie? But I also want to throw in there too. There's a lot of money on the side, by the way.
Oh yeah. So you're probably right about AI bubble. I think we're past the honeymoon phase, and I think a lot of these companies are going to have to start actually showing results. The ones that AI itself, I want to be absolutely clear. AI itself is not a bubble. I know it's the shiny new toy, but it's a fundamental change in how businesses work, as we see with the Palantir announcements of new contracts with SOCOM. It's a fundamental change in how we engage in kinetic conflict. It's here to stay. What I like is that it's finally opening up our eyes to exactly how utterly screwed up our energy is in this country. People talk about the national grid. Well, there's more than one, and that's kind of the problem.
Yep.
If nothing else, the endless thirst of these data centers has opened up people's eyes. Like, you know what? Our energy infrastructure kind of sucks. Maybe we ought to do something about that. Like, okay, yes, the tech companies, Amazon bought their own nuke plant. Like, how much of a flex is that? We're like, yeah, we bought an entire nuclear power plant. Cool. Meta is also looking at 4 gigawatts of new, not repurposed, new nuclear energy to run its data centers, and also the required investments in grid upgrades and infrastructure upgrades that necessitates. God alone knows how many billions that's going to cost. 4 gigawatts is larger than most of the data center projects on Earth, but that's where the trend is going. Like, in case people haven't figured it out, computers aren't going anywhere, and the data that drive them aren't going anywhere either. So that's probably my boldest prediction, is we're really going to see what AI can do. And as far as what that means, look, we need to be energy independent, period. I know we just recently, a couple years ago, I think we became the first time that we're a net exporter of energy as a country. That's fantastic. But even if you don't use that metric, the fact that I grew up in California, every summer you have rolling blackouts, you get your power bills, the stupid little cartoon on the back, flex your power, turn off the lights, go to hell. Like, that should not need to be a thing. You should not need to require people to have their circuits blown out just to keep your grid alive and well. So if nothing else, yeah, we backed ourselves into a corner with energy, but you know what? Maybe that's what we needed to finally pull our heads out of our asses. So that's one of my other big predictions for 25. People actually start making serious investments in grid infrastructure and in energy independence. And you know what? Drill, baby, drill. Like I always said, if you can't grow it, you got to mine it. And last I checked, I can't find an electricity tree. So that leaves only one option. And yes, that if you are into that sort of thing, that presents investment opportunities. But even if you're not, you should be aware of what's going on with the thing that literally powers your life.
Yeah, I mean, look, Biden has drilled a lot. I mean, we have continued to be, people criticize Biden administration on that front, but I give them credit. They have been continuing to drill a lot and continue to make us the top oil driller. But we need to continue that. But we also need to continue to invest in clean fracking, because natural gas is going to be a major factor because the more electricity we use, we need that. But also nuclear. So nuclear is going to be a big one, and we've been investing in that, and companies looking to invest in it. And nuclear is different now, ladies and gentlemen. It's a lot cleaner, it's a lot more efficient, and a lot more effective. So the waste is not really a major factor as it used to be. In addition, the likelihood of a meltdown is very limited. So it's just as risky as it's less likely in a car accident. So you're driving every day. You're more likely to die driving than a nuclear meltdown.
Especially the way some people drive out here. I think I'd rather be inside an exposed core.
Yeah, exactly. Another thing to go back to before you talk about policy on energy and all that, but
yeah,
another thing, you talk about debt, right? We talked about consumer debt going crazy. You talk about federal government spending debt going like crazy. Also, corporate debt is getting interesting, and people realize 2025 corporate debt rollover is due. There's a lot of government debt rollover. Correct me if I'm wrong, right? Government debt rollover is happening. That's in February.
Hell of a lot of commercial real estate debt rolling over.
Debt is rolling over. And also, we just saw Treasury auctions this past week, right? Last week, and it was really weak. So it was not good. So that's an indicator. So something else to look at that. But not to mention, you got to look at foreign markets. Economies like Japan has a major effect with our economy in the world. Obviously, some countries in the EU, but China is a big factor. People talk about, China and all that. But in some ways, we also have to keep them in check. But we also have to be careful strategically on how we affect their economy, because half of their economy, this just came out of the IMF, estimated that Chinese hidden local government debt sitting in financial vehicles amount to 60 trillion RMB, their currency. That's half of the GDP. So
it's terrifying. I shouldn't be laughing. That's absolutely horrifying.
Right. I mean, look, I am very much anti-China. I mean, I love the people of China and I love the culture and all that.
Yeah, we're anti-communist.
We're just
Let's just
anti-communist. I mean,
yeah,
look,
call
our
it what it
families.
is.
Yeah, you're Cuban, I'm Vietnamese. Our families came from communist countries, so shut the hell up. You have criticism, but that is very concerning because the global economy is very integrated, right? So if China has that problem and they start to have issues there, that's going to be a trickle effect. So that's something to also keep an eye on. So not only is that our economy is on the thin ice, but if that starts trickling, that's a big problem. So something to keep an eye on. Just something to know. And again, those are things that a lot of our peers are not looking at. And these fuckers going on CNBC and all that, trying to hype things up. And I'm going, you guys are, again, I'm not trying to be the Grim Reaper. It's just we're being honest, right? Because
The Vin Reaper.
yeah, because if we can be more honest, we can make better decisions and create pressure on lawmakers to make better decisions as well as corporations.
And here's the problem, Vin, is that all of this stuff is driven. Like, yeah, you have to take action. No shit. You have to know what action to take, right? You require data, and if we can't trust the data, because to put it, let me just be polite and say that China are not always forthcoming with certain bits of information.
Yeah, no shit.
I think that's neutral enough. All right, if you don't know what to expect, well, then how the hell are you supposed to defend against it? Yeah, and the problem with that is they may not tell us what's going on, us meaning the world.
Yeah.
I don't get emails from China. They end up in my spam folder. But it's like, if no one knows what's going on, do we have another Asian financial crisis like in 97? You know, it started with the collapse of the Thai baht and then just exploded everywhere. You had almost immediate capital flight. And you know how far we're a hell of a lot more integrated economically now than we were in the greatest year ever when I graduated high school.
No, my year was because I feel like the class of 2010 we were the last of the glory years, in my humble opinion, because we got the benefit of both the old school stuff, but then we got to integrate into the new stuff when we graduated. So it's like a mix of both. You know, we still had the red dodgeball. We still had that gym classroom that had all the stuff in it. All that. You know, we still had all that, right? We still had like the Nintendos. So we still had, no phones to call each other. We just met at a certain time. You know, if anything,
parents threw you out of the house in summer, said don't come back until dinner time.
Pretty much. So we still had that. So I felt like we were like the last. We were the last. If anything, we're the transition era into what we see today.
That's fair. I'll let you have that one.
Very thankful. Very thankful to be able to be in that era because you got to see both. Right, you still get to reminisce about those days, but then you also get to be thankful for some of the new things we benefit from today. But at the same time, it's also not the greatest thing because to me, social media is a fucking disease, in my opinion. You know, it's a terrible disease. I mean, look,
we can say that because we don't own stock in any of them.
Yeah, I mean, look, I don't care if I'm stalking them. I like social media when it comes to sharing things with your friends and and more like updating and all that, and also getting ideas. Right, I love seeing accounts that share about restaurants or share about travel ideas or the entrepreneurial accounts or the motivational accounts. But overall, I just think the web is a fucking disease because all these people on Reddit and all these accounts that are pushing this stuff or it's dangerous because it does highlight the worst of people because they can sit in their grandma's drawers on with the drawers in their grandma's they're sitting in their grandma's basement with the drawers on behind a screen. It's not like back in the day when you want to say something, you say it in front of my face, right?
And then you got punched.
Yeah. Anyways, that's Abolishing Nonsense podcast. Shout out to our other podcast and our other co-host Brian on that. But people, you can listen to that. That's more about those issues. But for Finex, let's get back to Finex. All these other things we're talking about, we mentioned a lot about the new administration and what to look for the next 4 years. Obviously, to educate everyone, the next 2 years are going to be interesting, right? The inauguration is January 20th, which is the official day when the transition happens. So the new administration kicks in. Regardless of your political beliefs, let's focus on the financial side. It's going to be very interesting, right? Because the new administration is going to inherit a lot. Right? We believe they're going to inherit the stagflation, the $15 trillion in debt that's built up on the books and the treasury. And it's going to be interesting to see what happens. Let's kind of break down what they're looking at, right? Some of the big questions we've been asked is tariffs,
Oh
right?
yeah.
Obviously, President-elect Trump has really pushed on tariffs and all that, and threatening everything. Obviously, the first people he threatened were our North American allies, Mexico and Canada. But obviously, Canada, Justin Trudeau flew down to Mar-a-Lago because, but it just shows you the influence that we have. But the lady president of Mexico came out hard against it, but then she kind of softened her tone. So make as, just take it as how you want to believe it. But tariffs. I am not a fan of tariffs overall because it did not do well in history with McKinley and all that. Right, we saw that in the presidency, but I do like it in some aspects. It'd be used as a negotiation tactic because the United States is the number one consumer, right? And yes, we may not make a lot of what people think, but we do have a lot of energy we export. We are a major service industry, and we spend a lot. So a lot of the economies that send stuff to us, we consume a lot.
Yes.
So they need us. But at the same time, I also got to look at other countries tariff the hell out of us as well. So, to President-elect Trump's defense, that is a true statement. I mean, other countries do tariff us. If you look at the numbers, I mean, we looked at it from a Trade Partners Center Bureau. The average U.S. tariff rate is pretty low compared to our largest partners, right? Ours on average is 3.3%, while the average in the EU is a full 5%. And that's even, and there's a bigger discrepancy when you look at Japan, China, and other countries. And the reason why they do that is because they want to make sure that domestically their economy is strong and that people buy more domestically and all that kind of stuff. I mean, travel the world. People travel. I mean, when you travel to certain countries, you don't see a lot of American stuff. And a lot of our companies actually build subsidiaries into those countries so they can have more flexibility to do more business there. So that's kind of where we're at with tariffs. So we do see kind of where he's coming from, but let's hope that they do it strategically in a way in where it doesn't impact our economy too negatively at a time where it's very sensitive. But let's see what happens, right? I mean, we can't really make a prediction on that because obviously we don't know where they're going with it. But if it's done correctly, I think it could be a very positive impact on our economy. So that's where my mindset is. What do you think, Willie?
I mean, I think first of all, people need to have a more global perspective on this, and I think they get scared by big numbers. It's like, oh my God, $200 billion. Okay, well, I don't have $200 billion, but on a macro scale, does that actually matter? And you brought up a great point. Tariffs are usually bilateral, right? Country A tariffs country B returns the favor. Maybe not the same amount. It just depends. How much does country B want what A makes? The fact is that a lot of the tariff talk has been focused on China, of course, and China, by and large, have tariffed the hell out of the U.S. Right, and they're not ashamed of it. We just like the macro picture with inflation and interest rates and jobs. We need to ask some hard questions, and it's like, you know what? Do we need certain people to be full trade partners? Do we need to re-examine what we can actually make in the U.S.? Yes, Chinese steel is cheaper. Is that necessarily a good thing? Because you have to wait several months or at least several weeks for it to get here on a boat. Logistics cost. People want to talk about carbon emissions. Well, should you examine that as well? The point is that I think you mentioned that tariffs can also be used as a negotiating tactic. Maybe that's a way that needs to be explored. Either way, if you have, whether it's a protectionist tariff or a revenue generating tariff, if you don't have an alternative, yeah, the consumer is going to pay more. But we need to actually look at some of those alternatives. Why do we offshore things in the first place? Because it got too expensive to make here. Okay, well, the physics of making steel from iron are not different in China than they are in the U.S. What makes it more expensive? Regulations. Is that something that needs to be examined? I think it should be. I think correct and responsible deregulation can address some of these problems.
Yeah, I totally agree. And I think people realize tariffs been around forever.
Yeah.
I mean, way back. I mean, it's been a thing for a long, long time, centuries. Tariffs have been a thing. So let's just see how it's handled. But we're not going to make any bold predictions. But it's just we just wanted to let people aware that it can be a good thing if it was strategically done and proper. And also to understand that, yeah, other countries tear up the hell out of us, and we're quite friendly in general. So let's see what happens. And and look, the current administration has kept tariffs or increased tariffs on certain countries, especially China. So you can't criticize President-elect Trump and his administration on that. So clearly, both parties see a problem with the trade discrepancies with China, maybe some other countries. So let's see. It's a bipartisan issue, to be frank. It's all about economics, and to me, economics should not see politics. It's just basically on fundamentals and numbers.
Yes.
This is why we love math. 2 + 2 is 4. You can't really question that. If you do, don't talk to me and go hide on. Yeah,
You're the more restrained of the two.
Yeah, go hide on a rock somewhere. Speaking of regulations, it's going to be a fascinating thing because obviously deregulation is a big part of President-elect Trump's administration's proposals.
Mm-hmm.
And like you said, responsible deregulation. Look, you and I are big capitalists, right? I'm a major free market advocate. But at the same time, the problem is fundamentally, yes, it's great, but you have humans involved, right? And humans are flawed, big time. And with humans being flawed, that means there's going to be, if you don't constrain them enough, they're going to run rampant. And we saw that in 2008 as a prime example. So again, responsible regulation, because you can't have too much, but you can't have too less either. It's a delicate balance, but let's see. I mean, Trump has picked Paul Atkins as the head of the SEC. Mm-hmm. So that's going to be interesting to see what happens. But one of the things that came out, it's about the watchdogs, right? The banking watchdogs. Yes. There was talk about either consolidating, limiting, or eliminating them. Well, you and I talked about this.
Yeah.
Definitely disagree with eliminating. There's a reason why these watchdogs, especially the FDIC, are in place, because it gives a comfort for people to hold their cash into banks, because that $250K insurance and guarantee is a must.
Yes.
And we need them. I mean, you saw in 2008 what happened. So we got to make sure that they are still there. Now, consolidating, truly believe in, because there is, government inefficiency is the biggest problem. That is what causes extra costs, and also things to be lost in the weeds, but also it creates abuse of power. And so I think consolidating is something that they should definitely do. It'll save taxpayers' dollars money. It will still protect, our citizens, but at the same time, it makes it more efficient and effective to regulate, right? Where it doesn't regulate too much or too less. Now, some people can argue it would do too much when it's consolidated, but you're stupid, because obviously, because it's easier to audit them, because you have an inspector general in this country, in our government, that audits things. So I think that'll be good. But again, we'll see what happens with that. It's always hard to predict what happens, but we will see. The bold prediction I have is you will see an era of major deregulation and a big boost to be a friendlier free market. That is a good prediction based on what's going. But the outcomes, we don't know. You look at this administration in the first term, very unpredictable. You don't know. So let's see. The only thing, to sum up, we can make a bold prediction on is we do see inflation going back up. Labor market will weaken. Stagflation, we think we'll at least enter into it. We'll enter into stagflation. And we see the market slowing down. So that bull market is going to slow down. Yeah. If anything, it'll trip and the bear will eat it. So we'll see what happens. Did I miss anything on that, Willie?
No, I'm not. I don't know if bears actually eat bulls. I don't know if that's zoologically possible, but I think you summed it up rather nicely.
Yeah. Another thing, too, is another question people were asking us, and I was surprised some retail investors knew this, but definitely our peers, it's about money on the sidelines. Obviously, that's a big factor. There's over $1 trillion on the sidelines that are sitting there that hasn't been allocated or being used, which is also a problem, right? I mean, that's and why is that causing a problem, Willie?
Well, it's simple.
You explained it pretty well.
If money's on the sidelines, it's because it can't be allocated, like you said. But if it can't be allocated, at least not efficiently and effectively, what does that say about the prices of what's available? If people want to say that the market's going to do a bull run forever, okay, well, if that's true, why are investors not buying in? Why is Warren Buffett sitting on $325 billion?
Yeah.
And
by the way, that's an indicator, by the way.
Yeah.
The last time he had this much cash was in 2008.
Right. And it's like, well, people need to understand, like, if you're an investor, you don't hold money because you like to swim in it like Scrooge McDuck, putting times into the vault. It's because you can't get a better return elsewhere. And again, a lot of this stuff that is propping up the market rally, A, is debt, and B, it's hopium. I hate to use a crypto term, but that's probably one of the cutest slang terms I've ever heard. It's not real. It's not substantiated by fundamentals, and it's certainly not substantiated by basic economic principles. So the fact that you have this much money on the sidelines, combined with everything else we discussed, right? There is no one stat to rule them all. But when you start looking at federal deficit, when you start looking at level of public debt versus GDP, when you start looking at level of consumer debt, when you start looking at what happened to the treasury rates after rate cuts, you look at housing prices, you look at everything in the aggregate, this holding of money on the sidelines should not give you warm fuzzies. It should only reiterate what we've been saying, that a lot of this stuff is a house of cards.
Yeah, no, for sure. So, I mean, all this is just going to, I mean, it's going to be interesting to see what happens. It just shows you fiscal tightening is not enough right now. And all this liquidity is just going to inflate things. And what happens when it comes rushing back in, right? So there's so many scenarios that are playing out that's just not looking good.
Maybe smart money knows something that dumb people don't.
Yeah, I mean, so yeah. Anything else do we need to cover? I mean, this has been a great episode. I hope we addressed questions from our listeners, and we thank you all for that. And hopefully, we gave some very good insights as well as market here. Some of our bold predictions that we just made. Bold predictions. Hopefully, let's see what happens about it. Sure, you can look back a year from now and see we're right or wrong. But I'm sure
this is one of those times where we want to be wrong.
Yeah, but I'm sure our returns will still be great.
Well, yeah, I mean that's not in question.
Yeah. Please, everyone. So happy holidays, everyone. It's been a great year. Again, we very much appreciate all the listeners and your support. Continue to send us questions that you have that can be very helpful. We'd love to address them. And we just love the fact that, we got so many comments. People just love listening to us rant about finance. But
we're going to do it anyway. We might as well have an audience.
Exactly. But we appreciate the love, though. I mean, everyone loves it. And they love being able to ask questions, and we address them as much as we can. I know next year you might be seeing a different background. We're going to have a studio, actually, because of all the love that we're getting. So we'll have a little studio where you can actually see Will and I in the same room, which I'm sure is going to make it more and more animated on our feedback.
We'll actually be able to throw things at each other.
Exactly. So we're going to have that in 25. I think 25 is going to be a big year for us. We hope it will be for our listeners too, regardless of the economic conditions. And so we'll sign off. Anything else, Willie?
I think that's it. Hope everyone has a good holiday season and enjoy New Year's Eve responsibly.
Yeah, that's it. And hopefully
responsibly as you dare.
Hopefully no drones crash in the Northeast. Take care.